China's rising demand for Africa's natural resources helped to re-establish the continent as a source of valuable commodities for the global market. However, the continued slowdown in China's economic growth as it shifts from an export-led to consumer-driven model has prompted debate on whether Africa's growth will suffer if China reduces its resource imports. This report from CNBC Africa's Nastasia Aronsa.
Africa has cities and a population that is 1 million more than Europe. The working class population is set to double to 1.1 billion between now and 2014. The cranes in the background show the much needed importance for infrastructure development in order to maintain GDP growth.
Africa has done well out of China's economic rise. 20 years ago, its exports to China were negligible. Today, China is Africa's biggest trading partner, with over 200 billion worth of goods moved between the two last years, and almost all the stuff shipped from Africa was raw materials.
Look, the Chinese economy is so big that any major change in the economy has an effect on everywhere in the world, including African economies, including South Africa. But it also has an effect on European markets, on European economies, on North American economies.
The International Monetary Fund predicted a further drop in China's growth to 7.3% in 2014, the lowest figure that the country has experienced in the last 23 years.
Good that the IMF's done it. We've been looking for 7% next year, 6.5% the year after, 6% by 2016. China's going to keep slowing, but the dollar GDP increase of this is just as big as ever. It's about $1 trillion a year. That's still an awful lot of consumption. Urbanization's only halfway through, so 50% in China. Similar in Nigeria. They're going to continue to be needing resources, even if they try and shift to consumption. But then you've got some real kind of key data points. The number of cars in China, 60 cars per 1,000 people. In the West, it's about 500 cars per 1,000 people. When the Chinese start getting in cars in bigger numbers, and it is increasing fast, they're going to be demanding oil. Where's that oil going to come from? Africa. Benefits not just from selling the copper or selling the iron or selling other resources, but it's going to be selling oil to the hungry, thirsty Chinese cars that will be driving around the country.
China's continued economic slowdown as it shifts from export-led to consumer-driven growth has prompted speculation as to the knock-on effect on economies that have benefited from the country's rise. Debate has centered on whether many frontier economies, including those of sub-Saharan Africa, are aligned on continued rapid growth in China's demand for commodities to drive their own economic development.
Africa actually needs to do more investment over the next few years. I think we're going to get that. You're seeing roads getting built in Kenya, Nigeria, ports getting developed, the telecoms network still being improved. So it's actually more of a shift. I think it's almost the counterbalance. So what you see in China is this slowdown in investment, boosted consumption. In Africa, consumption is doing well, but there's also a lift coming on the investment side.
State-backed Chinese firms are increasingly keen to make a better return, which may persuade more of them to look outside the home market for profitable investments, with almost 80% of these imports being African minerals.
It does mean that, for instance, manganese and platinum that you need for car construction will continue to be in demand, probably more so than before.
Although China has been a significant force in this investment-led growth, it is far from being the only source of capital. Private equity firms, which in some instances have been active across the continent for over a decade, have played a role.
Private equity is already it's a very competitive landscape in private equity. 10 years ago, very few private equity investors. Today, there's an awful lot. I mean, I've heard that there's standing room only at the IFC's private equity function at the beginning of this year. So there's definitely interest from the private equity space. But even if there is some slowdown in China demand for Africa, which I don't think there will be, but even if there was, you've also got Africa spreading its resources, its funding resources to the private sector. Borrowing in Eurobonds, for example, from Zambia, from Rwanda. We're going to get one out of Kenya in the next few months. So you've got borrowing from the private sector, and you've also got access to China, and access to World Bank, and private equity, and equity inflows and bond inflows. There's a flood of cash still available.
Africa's growing consumer class story and urbanization is also helping to concentrate pockets of consumer demand. The World Bank raised its economic outlook for sub-Saharan Africa next year, saying that strong domestic demand, coupled with higher production of commodities, will lift the region's growth above 5% in 2014.
We are now at a China-Africa relationship that is so complex and so diverse as it is with European countries, with American countries, with North American and Latin American countries, particularly the North American part. You will have to, whatever takes place in China will have an effect in Africa, as I said initially, and it will mean that you have to keep abreast of developments. Don't think of China-Africa relations as a static one. Something that was true 5 years ago or even 10 years ago in China-Africa relations is not necessarily the current state. You have to see where it's moving towards, to see opportunities, to see risks, and to manage them on the African side and to engage with opportunities in China in due time and actually benefit from them, make use.